to talk a little bit about the trends in Gen Y as they relate to their personal finances. And unfortunately, they're facing a lot of challenges. First of all, the cost of education is definitely rising, and a lot of parents can't afford their children's tuition costs. So that's forcing them to take out student loans, and it's leaving them with a lot of debt after college. Credit card debt is also common among Gen Y. Credit card companies made it really easy for young people to get credit cards, and a lot of them just didn't understand what they were getting into when they signed up. Another thing is a lot of them have really poor money management and budgeting skills. A lot of them see temptation out there when it comes to spending, and they have trouble curbing their spending. A lot of them also don't have access to financial planning tools. They're also not as disciplined when it comes to putting money away into savings. And there are also a few sort of environmental factors that are causing an increase in costs for Gen Y and a general lack of financial stability. One of them is the fact that the cost of living is increasing in a lot of places, but salaries aren't increasing. And for young people who are just starting out with their careers, they may not be offered a very big salary to start out with. Also, Gen Y is actually the fastest growing age group without health insurance. And they're also less likely than older generations to have access to a pension or a good retirement plan. A lot of them might be working part-time or they just can't find an employer that offers good benefits. So that can add even more debt to their plates. So the first product would be the credit card. Now, a lot of financial institutions might think that it's not responsible to give out a credit card to someone who has no credit history. But one of the pluses of offering a credit card to young adults is that it helps you build a relationship with them early on. It might be the first product that they get when they become a member. And studies show that most young adults get their first credit card during the transition period from high school to college, so it's important to market credit cards to them at an early age. Checking and savings accounts, these are things that might even be more likely to be a first financial product. I know they were my first financial products. And student loans, a lot of young people have to take out student loans. Now, credit unions can offer student loans in one of two ways. They can either carry the loans on their own books, or they can partner with a CUSO like CU Campus Resources or CU Student Choice. And they can help you with things like technology and underwriting and pricing associated with student loans. Now, a lot of experts I've talked to say that student loans are not the most profitable loan product out there, but that they can also be rewarding because, again, they can help you build a relationship with a young member. So that's a key product for Gen Y. And then consolidation loans. These can help young members solve their existing debt problems when they come to the credit union. And then auto loans. A major step for young adults is buying their first car. So you want to make sure that they're aware that they can get a much better rate on an auto loan when they come to a credit union. Finally, there's mortgages. Now, the importance of mortgages to young adults can really depend on where they're located. If they're located in a small town where real estate prices are relatively low, then they might be looking at buying something when they're 25. But if they're living in Manhattan, then it's more likely that they're probably going to be renting well into their 30s. So that's something that should be considered when marketing mortgages is where is your young membership located?